Do you have a website, an external presence, employees, an office? Any of these things can be compromised and attacked. How are you defending these assets? Have you penetration tested these public assets? Start 2017 by taking a proactive approach to securing your vulnerable areas. Black Hills Information Security has been helping companies find their weaknesses since 2008. Email consulting@blackhillsinfosec.com and see how they can help you sleep better at night.
Episode 55, we're back. We're going to do some news, some stories. We're going to talk about stuff in security. But first, I have two more announcements that we're going to go through before Matt and I get into the conversation of the week. So check out Endgame's webcast. It's coming up Tuesday, September 19th from 4 to 5 p.m. Eastern. So that's next Tuesday. Endpoints, the breeding ground for malware, malicious payloads seeking to do all sorts of nasty things inside your network. When determining which product will be the most successful for you, what do you find most important to consider? The detection rates, the deployment capabilities, scope, maintenance, resilience, or a mix? Register for this webcast to hear Paul, John Strand, Mike Nichols. They're going to get together. They're going to weigh in on endpoint detection, protection, and response. You can sign up now. Register at securityweekly.com/endgame. That's always entertaining. I think you'll enjoy that. B-Sides Connecticut, B-Sides CT is a day-long information security conference. It'll be in Southington, Connecticut, October 7th, 2017. That's a Saturday. They have an exciting lineup. I can't talk today. They have an exciting lineup of speakers and a challenging capture the flag waiting for you to take your best shot. Due to an incredible response, the general admission tickets are currently sold out, but they have a wait list available through Eventbrite. So if you go to bsidesct.org, you can sign up with the link and you can get on that wait list. And if anybody can't make it, they'll alert you as those tickets become available. The sponsorship packages, though, that include tickets are still available. So this is a way to help them out and get access to the conference. You can take a visit at them, bsidesct.org. Check it out! ! All right, so startup articles in discussion. I put a couple different things in there this week, which is fun because Matt and I banter these types of things around. One of the things that I put out that I kind of liked, I think we're probably going to spend some time talking about both scalability and looking at elevator pitch. But this first one I thought was kind of interesting was how some of these people overcame their different obstacles, right? And what we can learn from doing it. And the same thing here, right? Explaining your value to potential customers. And what's interesting is the way this opens up. And I feel like this is stuff Matt and I talk about all the time. When you go talk to a startup, when you're in startup mode, you're so close to it. You're so excited about what you figured out. You've had your eureka moment. Everything's coming together. And you're like, I can totally go explain this. People are going to love it. And you say it, and they just kind of look at you. And they cock their head, and they go, okay, neat. And it's one of these things is it's really challenging sometimes to help somebody understand that context and figure out their value. And the idea here is, if you want to get past your failure, if you want to make something work, go figure out your value and go explain it. What do you think? Is that where people should start, Matt? Like this is their top one. You think it's the top?
Yeah, absolutely. I mean, you and I have been talking about this for months now as we've been doing these shows, and we had a show dedicated to aspects of this a couple of weeks ago. Look, there's three in here, and they're all interrelated. The first one is value. The second one is how to pitch to investors, your value. And the last one is your category, which is you don't necessarily have to do it different. You can also do it better. And the example here is they found a way to do it better, right? And so these are all interrelated on the topics we've been talking about for months. How do you take this really cool marketer technology that you just found the problem in and figure out how to articulate its values to not only share with the market, but potential investors? And how do you get out of the noise of some of these large categories where you can set yourself apart as being different or better than the way everybody else is doing it? And that's exactly what this article points out. I thought it was really tied into what we've been talking about.
Yeah, I mean, a lot of times I pick this stuff that conforms to a bias of some sort, but I have to tell you, because you advise a lot of companies on this, and I take these pitches and I'll say, okay, well, what problem do you solve? They're like, yeah. And then they just lace into jargon, and I'm like, right. So I've been doing this 20 years. I don't get it. I don't understand it. Can you try again? help. And
Well,
so it's why we keep bringing it up. By the way,
Yeah.
right? And you've got a knack for it, but people tend to overestimate how easy it is and underestimate the work that really needs to go into it.
Yeah, I do this all the time now. It's crazy because every time I see a press release, I go to the website and I try to dissect it, right? And it's like, okay, I don't get it, and we'll talk about a couple later in the news segment. But it's hard because as technologists, we think about the technology and all the coolness and all the innovation we did in the technology, not necessarily the problem, or even who the buyer is. If you don't understand who the potential buyer is and what are they facing on a day-to-day basis, and really start to articulate out how do I help them, nobody's going to understand this stuff. And it's for technology people, I think that's hard to understand. Sales guys get this, right? Sales guys start to understand who the buyers are. They start hearing it in the field of some of the things they're fighting. How do you bring that information from the sales guys back to the product team and really start to articulate this message? And that's where guys like you and me and others come in and say, okay, we've been on both sides of this fence. I did a lot of sales and BD in my early career. I still do some alliances work today. If you don't understand that side of the business, it's really hard to do this. So don't underestimate the amount of work it's going to take to extract that value out.
Yeah, you pointed out something I think is really interesting too, is that, a lot of the clients that I work with, they've got the sales group and then they have the services team or they've got the product team and they're not connected. Like a lot of times, where they're not always bringing me in to say, figure out the value prop. They're bringing me in and go, okay, so we're not all on the same page. And it's fascinating because I'm like, well, what are you selling? Well, like this. I'm like, well, what is this? But what I'm also seeing now too, and I'm excited about this trend, we're seeing more of this happening now on the enterprise side, where I'm actually going and I'm teaching people about value prop. It's great. Look, if you're an enterprise leader today, it's really, and I keep pointing this out. Like, take about this for a second. Explaining your value to potential customers. If you're an enterprise leader today, that's pretty much everybody in your organization. How are you explaining yourself to them? Getting investors on board, right? So do the executives understand what it is you're doing? Are they willing to keep funding the things that you want? Making yourself known in the crowded market. Are you recognized for the things that you're doing? Do you stand out? Are you the party of no, or do people expect you guys to come? What I love about looking at startup is if you're running a security team today, everything we talk about completely applies to you. But what I'm starting to see now is that we're starting to do workshops which have this really cool secondary benefit. If you're a security team today and you're better understanding how to articulate the value that you offer or the value of a project that you offer, now when you go talk to these vendors and they come to you, you can actually ask these questions. And it's not about being negative. It's not about playing gotcha. It's actually sometimes they know the answers. They don't know how to explain it, and we can backlead them. We can ask some of those questions, and we can pull that information out of them. So we've got to work
because these guys want to be successful in their careers, right? And so if they can articulate their value to the bigger part of the organization and move their products forward from an investment budget perspective and really start to stand out, they're going to propel their careers too. So this you're right. We focus on the startups here, but people can use these same skills to market themselves and improve themselves and move up the value chain in their organization or in another organization.
Yeah, I mean, as we live in transition here to looking at this next topic, I mean, that's one of the things that I find a lot of times. A lot of the folks, and Paul and I talked about this last week. I'm actually doing a full day. I've got a keynote and then a panel and then some private coaching at a conference coming up in October, looking just at security leadership for CISOs. A lot of people, they aspire to it, then they get there and they're like, wait, I'm not an independent contributor anymore, and now I've got to have influence, and now I've got to market, I've got to sell, I've got to figure out value. People are coming to me. Everybody wants my time. Everybody wants money. And it's the same thing. And I think it makes a lot of sense. All right, I'm curious, Matt, your take on some of this. In fact, I'm even curious if you even like the article or not. It's a complete guide, which means it's probably not complete, but it's talking about startup advisors and mentors. And one of the things that you'll see a lot of times, especially in our space, is startup gets going and they, well, look, we've got an advisory board, and they have their pictures and their names, and some of it's really impressive. And then sometimes they'll talk about we've got mentors, or you'll look at the accelerators and they've got a whole list of mentors. And a lot of us have served as advisors or mentors, or we're an advisory board. Does it matter? Is this stuff important if you're in a startup today? Or is this an area that, Matt, you think people should spend time?
So I got two takes on this one because I can, from the startup side, but also a little bit on the enterprise side, because people kind of mix the two sometimes. Look, having people who've been there, done that before, advising a new team on some of the things they need to do, I think is good, primarily from a focus perspective. Look, the shotgun approach doesn't work when you're a startup. You got to start to focus, right? And this goes back to the conversation we just had, but it also is, where are strategic alliances? Who should we go partner with to move the needle? What are we going to tell the investors? So having advisors on board that know aspects of influencers in the industry, investors in the industry as you go out, I think there's a lot of value there in having those people on staff in providing guidance, right? They will point you in the right directions. They will keep you focused on what you need to do in the early days to be successful. Now, flip that to the enterprise side for a second. Everybody wants an advisory board. Advisory boards are good, even on the enterprise scale, but they're not a sales mechanism, which a lot of people try to use these customer advisory and these advisory boards to drive, hey, if we have all these advisors on, we're going to sell to them. It's not a selling component. You really have to leverage the advisors as these are the next set of things you need to do, or to bounce ideas off of, to really put the company on the right track for what's next, not as a sales arm to say, well, we brought all these advisors in from these really big companies because we want to sell to them. Don't use your advisory board for sales, because it gets really dangerous really fast.
That's a really good point. I'm really glad you brought that up. What's your take too on mentors versus advisors?
Yeah, they use them a lot in the same context. Mentors are interesting. Mentors are good, I think, for new executives who need to continue to improve themselves, right? So the difference here in this article, I think, was really good, which was, look, mentors are for individual people, advisors are for the company. And if you take that same vein, then having mentors or coaches to help new CEOs kind of work on their personal skills and their leadership skills and those sorts of things are good. Advisors are really there to move the company forward as a whole and not necessarily maybe focus on one individual. So potentially there's a need for both, depending on, has the CEO done this before? Is he a brand new CEO? Does he need somebody to be more of an individual mentor to him versus an advisor from the company perspective?
I'm glad you highlighted that. That's a really cool distinction. And what I would say too, and I've seen where some people can play both roles, right? They can mentor the individual. True. And the thing I always like, when I look at, not all do, some can.
Right.
What I look at from an advisor perspective too, because I'm a stickler, like, for example, and I'm going to take it because it fits here. Like, I'll look at contracting versus consulting versus advisors. And the way I've always explained it for years is, let's say you got a pile of rocks on the front yard. You can give someone a shovel, pay them $50, tell them to move the rocks. You can hire a consultant, and they'll show you how you can optimize it and get it where you want it to be, and they'll handle it for you. The advisor is the one that comes up and says, why do you want to move the rocks? Right. And so what I always look at with advisors is it's somebody who's going to ask questions. So a lot of times like, oh, they're an advisor, going to tell me what to do. In my experience, they might, but man, I sure like the advisors that have been there, done that. And so they're going to ask questions. They lead. I think good advisors, in my experience, they tend to lead with questions because they want to make sure that they both understand your context. And sometimes they kind of want you to see some stuff in that too. And I think that's useful.
Yeah. And they're going to push on you. Right. And they should. They're going to question, well, why would you want to do that? Why wouldn't you do this, right? So they're there to help vet. Why, right? They've been there and done this in certain cases, so they should push back and really challenge, well, why do you want to do that? Why wouldn't you do this instead? So that's what you should use these advisors for.
Yeah, and I guess all I'll say as we'll go to a topic you and I like with elevator pitches is, if you're fortunate enough to have an advisor, even in your professional career, who asks those types of questions, don't discount them. They're not asking those questions just to be a jerk. There's something behind it. And I've seen a lot of folks are like, oh, yeah. I've been asked that a lot. Yeah, I don't care. And then, they crash and burn because they didn't pay attention to it. So that's the rest of it. Like, if you're going to spend the time to go get mentors and advisors, then cherish that, honor that a little bit. All right, elevator pitches. Paul and I went through a cycle probably about a year ago. We spent a lot of time on this. I mean, communication, collaboration, connection with other people. These things are all really important. And what's interesting is, we talk about these elevator pitches. To be fair, they drive me nuts. This whole concept of, you're going to get in the elevator on the ground floor, you're going to drive up, and you're going to ride up, and we've seen them. They're not always just for selling. It's like, what if you get in and the CEO is there? What would you say? You've got 15 seconds to make it to 10th floor. Good concept. The problem with it is we go sideways with it so many freaking times. But that said, it's going to persist. So I'm going to keep bringing them up from time to time. And, one of the things that I like about this is that it fits a lot of the stuff, Matt, that you and I tend to talk about. So what they said here was, look, here's 5 things you got to have. You got to be able to describe your problem. You got to talk about your solution. Now, they say the underserved market, existing solutions and competition and revenue model. So just so we're clear, this is from a startup-focused thing, and they're saying it's an elevator pitch. This is your chance. You're going to be in front of an investor. This is stuff an investor wants to know. I would say an elevator pitch is different. So if you're actually trying to pitch somebody that you think would be a customer, they probably don't really care about the underserved market. That's not necessarily interesting to them to some level. But what I would say, by the way, you've got like 15 seconds and you're going to cover 5 points. That means you've on average got 3 points a second. In my opinion, I'm a big fan of just describe the problem, right? I mean, we talked about this at length, talking about category. I think if anything else, I talk about isolating and elevating. If you can get that problem nailed, where that person goes, tell me more. I think that's the goal out of this. It's not to close a deal by the end of the elevator ride. But you tell me, like with the stuff that they've got here, and maybe you like elevator pitches better than I do. I think it's an ill-fated concept. I like the idea of being succinct. I like the idea of being short and punchy with something. But where do you think, and what do you think of these tips?
So I'm going to break this down into 2 pieces because I think it's important to understand the difference between a couple of these. To me, the elevator pitch, problem, solution, value.
Yep.
Value's missing out of this list. Okay.
I noticed that.
And how do you get that succinct into a 15 to 30 second pitch? If you can't articulate the problem, your perceived way that you're going to solve this and the value you provide in a quick 15 to 30 second way, then it's too long, right? So what's missing here on that type of pitch is the articulation of the value. That's missing. If you're going to take this approach for the investor deck, it's on par, right? Because you got to talk about what's the TAM, right? And how much of that market can you go capture? That's right. Part of category design and the whole play bigger concept that we talked about.
And please don't say it's everybody. Every business. Yeah, right. Stop. No, nobody believes that.
No. You've got to have a realistic expectation of total addressable market, and you've got to do your research, and you've got to be able to support it with facts. And so this is some of the work that I do for some of my clients is really try to articulate: is the market a 500 million or is it a billion? And there's a difference there,
and it's a huge difference, by the way.
It is.
And let me just make a note on that too, because when you go talk to, you're obviously doing it. This is a note for other people. When you're talking to investors, if you go look at the unicorns, or like I got a report this morning, the top 15 most valuable companies, VC funded companies right now. There's no security companies on that list. They want billion-dollar valuations. If you go and they want multi-billion-dollar addressable markets, if you look at security, if you can show a disciplined security investor that there's a $200 million opportunity, but there's not a lot of competition for it right now, that's great. Like there are people that will greenlight that. So don't be shy if you feel like, but it's not a $1 billion market. That might be okay depending on the need.
It'd still be a $200 to $250 million company.
Yeah.
And be okay, right? So I like the market model in here. The competition. If you have competition, why are you better or different? It's good to have. Going through one of these exercises right now. The revenue model. Look, and this ties into one of your other articles. The dozen attributes to a scalable company. Guys, it all has to do with SaaS, recurring revenue, et cetera, right? So revenue models matter here. How are you going to grow that? Recurring revenue streams start to build hockey sticks as markets grow. That helps, right? So that's important. But there's 3 here that I felt were missing off of an investor deck. What's your ask? How much are you asking for? How are you going to use the funds, right? That whole piece was missing in this article. I'm like, well, you got to articulate the ask and why and what you're going to use it for. You need proof points. Look, investors want proof. I had a call earlier this week with one of the VC firms you connected me with, actually, Michael, and he said, look, we've got to have revenue and customers. You need proof points. Who's using this stuff? And if you can't articulate somebody who's using it and you don't have enough revenue, the investors aren't that interesting. It's really hard pre-revenue to get funded by some of these firms as a Series A. So you better have some proof points of who's using your technology and what you're doing. And then the last one, you have to articulate, I think, what's that longer term vision? Granted, there's a problem. You've got a specific solution, but what's that longer term vision? They got to understand that there's more than just a one-trick pony, I think, in some of these deals, and that there is ability to expand further. Well, so share that vision.
Let me ask your opinion on this, though, because I've done this now to some founders when I take briefings with them or when I explore working with them, and I'll say, what's your exit look like? And a lot of them they'll kind of, I don't really want to talk about it. And I'll say to them, hold on, though. Are you a feature and you get acquired, or are you a platform and you're going to go on the acquiring spree? And those aren't obviously the only two I go, but like, what do you see in that? Do you see harm, Matt, in somebody saying, I know how to solve this problem really well? And I think, frankly, when we go kick ass at this and we're the best at it, someone's just going to come snap us up and we'll fit great. And you know what? There's 5 companies that are acquiring something and the multiples they're paying are going to be fantastic. Is that a death knell, or does that signal to an investor, wow, these guys actually kind of get it? They're going to be a feature in 3 years, but right now they're kind of hot and they can make it work. What do you think?
Right. So I think the startup folks need to understand their best chance for exit, because I think it influences who they look at from a VC firm. And we've talked about this a little bit in the past, right? Look, if you think you're great and that eventually you get snapped up because there's an adjacency market that really just needs you, then you're going to go look for VCs that really like strategic M&As, and you're going to go find guys that are funded with some or have really close connections with some of these potential strategic acquirers. That would be a really smart thing to do as a founder, to figure out who your investment vehicle is. Because if you're going to the Sequoias and the Andreessens and the Bains, right, they want to turn you into unicorns, right? Which means you got to think, okay, we're going to go raise hundreds of millions of dollars in cash. I mean, hundreds. Every 18 months, you're going to be on a fundraising spree, and you know your exit is probably an IPO. Then that's who you want to go put in your corner, right? So, yeah, I think the founders have to have a little bit of that, because they've got to say, do we have the right investor for what we would like to see happen with the company? It's your baby, right? I think you should have a little bit of that vision on where you go. Maybe you don't know it exactly. Maybe you think you want to go public. Trust me, startups, you don't want to go public.
Yeah.
You want to find a strategic acquirer and get bought for a good multiple and go do another one. Seriously, I mean, IPOs are not easy, and getting yourself ready for an IPO is not easy. In fact, so
there's an article that just came across my desk. I didn't read it yet, but there's a company that they just raised a boatload of cash to start helping companies go public without IPO. So I didn't get into the underpinnings of the mechanism on it. So if it's useful, we'll bring it up in the next show or two. But but to your point, yeah, and I think you raise up some really good points. You know, I want to go back to when we look at the value, we look at the problem. You know, these are your opportunities to capture attention. A lot of people forget. You know, and you said, like, what's your ask? Yeah, like if you've got an elevator pitch, what do you want to happen at the end of it? Let's say you're actually on an elevator. Ding, the door is open. Do you want to be like, well, thanks, have a nice day, and walk away? Or is there an actual purpose? Did you have something you wanted for them? By the way, same thing happens on the enterprise level. You know, take the same concept here. Now, you're not necessarily going to talk about an underserved market or whatnot, but if you just go back to what's the problem, what's the value, right? What's the impact? How is this going to benefit us? And why do I need your support? What's your ask? I want you to take a meeting with these people. I want you to support me when I come to this. Can I come brief your team on this? You have to
eval
be
it. What do you want?
Yeah.
There has to be an action, right? There has to be, hopefully you create a sense of urgency where people want to do something next with you, and you should know it before you go and do it.
Yeah. Like I always like it if somebody says, like, one more piece on this, because what I find a lot of people is when they start getting into this, they want to be prepared for every contingency, and they'll say, whoa, we've made it too simple. I mean, that doesn't talk to the guys. You got like 30 seconds. Don't worry about being too simple. As you said, Matt, I want to build some urgency. I want to get you excited. I want you to go, really? How so? Not like, really, I hear this all the time. Please stop. It's the same jargon. I want somebody to go, okay, that's interesting. How do you do that? What are you looking for from me? And if you can get to that point, good. Then you can go have your nuanced conversation. You can set the context. You can bring all that stuff in. The key to this is you've got to get really distilled on, what does this person need to know if I want them to take this action? That's it. And that sounds so easy to say until you're in the moment and you're like, all right, how to grow a startup. 5 best tips I've ever learned. Look, the thing that I thought was kind of interesting on this one in particular, I liked 1 and 2. Don't take the hacks out of their context, and 2, don't experiment with many acquisition channels at once. These both, to me, talk about being focused. Like, we'll see this a lot of times, and I think on this program, we try to say to people, here's the context. I see it a lot in leadership and communication. People say, well, so-and-so does it that way. I'll do it that way. Yeah, hey, newsflash, you're not Steve Jobs. It's not going to work for you. You're not Jeffrey Immelt. You're not Gordon Ramsay. You're not any of these people. Like, you're you. Like, do you have the same context? Do you know if or how it fits, if it works for you or not? And I see a lot of people, like, they read it and they just go do it. It's like management. Like, I read a book this weekend, and now I'm going to come in and I'm this new thing. I think it's dangerous to chase after those things. I think it's a really good idea. But same thing with these acquisition channels, and I think that the two are connected. There's so much stuff that you get flooded with today. Like, here's the hack for LinkedIn. Here's the hack for Facebook. Here's how you can make Twitter make money. Here's all the stuff you've got to do. And you go look at it and you're like, who the hell's making money with this stuff? Like, what? Like, it seems mostly the people making money with it are the people selling people on how to make money with it. And I think that, it's
if you're in the business of multi-level marketing, that's great.
It's awesome.
Yeah. Not for a startup. And this is where your advisors come in, by the way. They're the ones that are supposed to help keep you focused, so you're not off doing a bunch of ancillary things, right? Look, most startups are going to start with, okay, I got some level of direct, and then I got to go look at other channels. And based on who you are and who you're selling to, certain channels will start to make sense and others won't, right?
That's exactly.
Do you need a distributor? Do you need a VAR? Maybe not, right? I mean, you have to understand what those channels are good for and what they're not good for. And if they're not a fit, then it doesn't make sense to go chasing after these, because they take a lot of work to nurture and to cultivate, to get value out of the other end. And so you better kind of know up front.
All I was going to say is I feel like we need to do another program where we go focus on channel and talk about channel. Because I think there's a lot of misconception. I think for the people that are in the channel, I think for the companies that try to work with the channel, I think for people who work with their channel partners, like it's an area I've been on all sides of, and I'm always amazed at the amount of friction and confusion that exists in a channel. And as we're talking about this, it's some companies are 100% channel, some are channel friendly, some can't stand the channel. And there's 2 more pieces in this article that I really like. The first one says, don't do things that don't scale and focus on a small niche. And I think they're all the same thing. It's what I find that happens a lot is because, right, and we're in a minute, we're going to talk about scalability. Everybody's so focused on scalability out of the jump that they don't get the experience they need to understand what they need to scale. And so if you go do the things that don't scale, in my opinion, you start getting a lot of those insights. And then you get to that point where you're like, okay, this isn't scaling. What do we need to do now? And I suspect there's probably some risk there. What are your take on that? I mean, should we always be looking at scalability from the jump?
Certain pieces I think you have to start to think about, primarily from a tech debt perspective, right?
Okay.
Look, you don't want to do architecturally things that aren't going to scale because it provides a lot of technical debt that you have to go clean up later, right? And a lot of companies have had to deal with aspects of that. So there's certain types of scalability I think you should account for. Not that you have to solve it day one, but you better start thinking about it so that it doesn't create a lot of technical debt from a development perspective later. But in the article, it was talking about, hey, go out and let your friends eval it and go put it in this channel, this area, what it does is, one, it gets you start to create a little bit of a community, starts to provide some very interesting evaluation and feedback. And yeah, it's not optimal because you don't have a support channel set up, or you don't have, you're doing a one-off service POC over here that won't scale when you have to do it with 1,000 people. But each one of those provide hopefully some level of validation of what you're doing, feedback in to make the product better. And then over time, you'll be like, okay, we can't keep doing all these manual POCs. So let's take the lessons we learned from some of these ones we had to do manually. How do we make that better so that we can get the scale out of the sales side, right? And so they'll just help you. So I'm not opposed to it. I just wouldn't go too crazy early on, because the other mistake I see a lot of startups make, they get funding and they hire like an army of people, and then they burn all their cash before they get market validation. And then by the time they do, or if they don't, they run out of money, which creates some very interesting down rounds and B series and other things, which we might have a couple of those on the list for later in the news.
Yeah, well, I think you raise a good point, and I'm going to bring that then to the focus on that small niche. I'm going to kind of take it my own direction with this a little bit, but a lot of people. Like, this is talking about the size of the market, right, and the TAM and everything else a little bit. But what I'll see a lot of people do is they're so fixated on we just got to get revenue that they don't think about where the revenue is coming from. So they'll break it up into all sorts of different sizes and all sorts of different things, which means you can't really form that target profile. So what I like about sometimes doing things that don't necessarily scale, in fact, what I would probably add is don't do things that scale easily at first, right? But to your point, do the things that get you validation, do the things that help you get the experience you need in order to move forward with it. It's fascinating to me if you talk to a small company, a startup, and you're like, so who do you work with? And like, oh, we work with everybody. Okay, well, who do you work well with? Yeah, no, everybody. Okay, no, is there like an industry? Is there a size company? Is there a specific problem? Is there a profile? And, to be fair, I've found myself guilty of this a little bit. And one of the ahas I had in the last week was really looking at where I make a dent. And then suddenly I was like, wait a minute. If I'm working with security leaders in this type of an organization that have this type of a problem, and most of them are attaching what they do with me to a specific project, then shouldn't I go figure out the projects that are getting the most amount of funding right now, but that also have the highest amount of friction? Michael, you've been talking about this stuff for years. Wouldn't it be great to finally do it yourself? And it's and I think it's interesting because the way somebody explained it to me a really long time ago, like longer than I care to admit, was the more stuff you do, right, the flatter it gets, and it's just a big impact. But the narrower you get, the easier it is to get in. And if you can get in and you get that experience and you can reproduce that, then you can start scaling that, and then you get the credibility. One of our guests a number of shows back said, if you're in a particular industry, go for 5, 6, 10, 15 people, really build up your reputation in that industry solving their problem, then make that pivot. So if you've done financial services, you're really good at it, and you've got the credibility, you've got the testimonials, you've got the case studies. You're known for that. Good. Keep selling to them. Now you want to branch out. Good. Now go pick healthcare or pick insurance or pick energy or whatever you want to do, and kind of follow the same pattern. And I find more and more the companies that have been successful have had that level of discipline. They stayed really narrow, not for the life of the company, but just to get going. And then they started to figure it out. Do you see the same thing?
Yeah, well, one of the questions I ask in the buyer persona side of the equation is target customer, right? Yeah. Size, vertical, because they matter, right? You've got to understand what types of companies are buying, as well as who's buying within those companies. So you can start to focus, right? So I agree 100%, right? You can't go after every industry. You can't go after all sizes. It's really hard. So I think you have to say, look, if the company looks like this, then they are probably likely to be a buyer, and therefore I should go target these buyer personas within that account. And so it focuses some of those early sales to get in, get some validation. Then you can replicate it within that industry, and then you look for your adjacent industries. So I fully agree. That's part of the questions I ask when I figure this out, because look, not everybody is going to serve the large enterprise. Not everybody is going to serve the SME or the SMB. You better know where your sweet spot is, or you're going to be wasting a lot of time for people who are just not interested in what you're offering.
Now, one of the things I tell people too is that if you figured out, a lot of people get afraid that if they niche too much, they'll never get the business later. It's a missed opportunity. And what I've tried to explain, but maybe you've got a different take on it, or maybe you've got some better insights on it. What I've often tried to explain is that there are certain things that might be slightly more universal. So the better you understand your target customer, the better you understand their buying habits, their needs, their challenges, their language, right? In my world, the easier it is to translate your value into their understanding. That's great. Well, by the way, though, if you're at a conference talking about it, or somebody else sees it, or they stumble upon your blog, or they see a news story with you in it, and they're an early adopter, they're highly motivated, they're going to call you. Like if they look at what you're doing and go, that's exactly what I've been looking for. They don't care that you're only doing it in a sector that's not theirs. If they like what they see, and my attitude has been, those folks, they're awesome, and they'll reach out to you. My second attitude is, and sometimes you're still not going to work with them because they don't fit, because it's not your sweet spot, because it's a huge distraction for you.
Yeah.
But because you're solving those problems and you're building that evidence, when the time comes, as you said, you find the adjacent industry, it's just a little tweak. We did it here, and you know what? These problems are similar. Here's the difference. We understand it. Here's how we can help. I mean, do you agree? Like, do you think that companies that even when they pick their niche, somebody comes along with money and wants what you do, then you can make a decision, right? Either I'll take it, it's a good fit, or you're not in the groove that we're in. It's not going to fit.
Yeah, and I think you have to understand it, like I said. And look, everybody's going to try to form a startup that goes after a really, really big market and big TAM, which means lots of different industries. Again, focus, pick some that are the most likely based on what you're doing, the problem you're solving, who's buying it, who needs to buy it. It doesn't mean that it can't be morphed and transitioned into other industries later. It's going to depend on what are the specific requirements around each industry. Compliance type solutions are ones that you have to typically do more work on because they're very specific by industry, right? So if you're in healthcare today and you're focused on Gramm-Leach-Bliley, and then you want to pivot and go into healthcare, and now you got to do HIPAA, yeah, you might have some work you have to do and language changes and other things. If you're going after broader technology challenges in certain areas, some of the companies I advise in the patch management side, the container security side, cloud security stuff, look, everybody's dealing with this stuff in certain forms or fashion, right? Some are going to lead in certain industries. Other industries are going to be like 100% or 0% of what you're trying to do. So you just got to find them. And then over time, as they started doing more adoption, your message will fit into those industries, and that's okay. Yep. It might be a slight shift, but I wouldn't freak out about it too much up front. That's why I also try to keep things a little more pointed but generic. I try not to get very pointed where the language only fits in a certain market. I guess unless you're government and everything you do is FedGov, then maybe you can get away with that. But in other places, I try not to get into too much specific of language that it only resonates in one industry.
I think that makes a lot of sense. Let me clarify. I'm looking at that colloquial level, like where you're talking to somebody, kind of the way they do. You're right. Like I don't think highly specific jargon is ever a good strategy. Like I don't like it at all. I want to get to some of the happenings, but this dozen attributes of a scalable business. I pulled it up and I went, I don't know if this will be any good. And then as I kind of went through it, I went, oh yeah, wow, this is really solid. And it's fascinating because as I looked at this and I thought about a lot of the companies I've worked with in the last couple of years, most of them couldn't answer these questions. Like they don't understand this element of the total addressable market. They don't understand what their acquisition costs are. They don't understand the product market fit. Their unit economics they just don't know. So is there anything in this list that you thought really stood out as startup, go pay attention. Or did you like them all? Or did you like none of them? What did you think?
When I look at the characteristics, I just think of, okay, we're moving to the world where service-based models in the cloud with recurring revenue streams create highly scalable companies. I mean, you could take almost all 12 of those points and go, now you know why everybody's trying to build a cloud-based SaaS with a recurring revenue model, because that's what creates scale. And valuation, by the way, as well, as you think about, the exit. And so those 12 characteristics just to me kind of summarize why everybody's, trying to move away from on-prem perpetual maintenance offerings to cloud-based SaaS recurring revenue models, because you meet almost all those criteria right out of the gate, which means you can create a scalable company. Good. That's what I took out of it.
No, I think it's good. As I was listening to you explain it too, I've realized there's a bunch of apps that I use just in the course of doing business that in the last 6 months have gone, you know what, we're not just going to sell you the app every year. We're a subscription business now. And some of them I think have gotten it right, and some of them you kind of look at it a little differently. And a couple of them have gone into great detail to explain. It's funny, I'll go back now and look at it, but they've essentially explained these things and said, if you want us to keep doing the stuff we're doing, the way we're going to do it is this. And some people bitch about it. I've been somebody who's kind of excited about it. All right, so the notes, the moves in the world of a startup this week. AppGuard, $30 million, Series B. Thoughts?
Huh. No. Okay. So let me explain to everybody. This is $30 million after $70 million 3 months ago, $100 million in. AppGuard is an endpoint prevention technology. There's a lot in this space. Parent companies out of Japan, they raise this $30 million and they buy KeepTree, which is a video company. I don't see how all these pieces fit. And I'm like, $100 million? Holy cow. Where are you guys going? If you're an endpoint prevention company and you just bought like this video company, I don't even know how those fit. So I was really confused on this one. And like I said, $100 million, a lot of money to come in. That means you're valuing yourself somewhere north of $500 million. I don't know. I didn't see it. So that was my take.
Yeah, I'm with you. And then as you and I have talked about it, one of the things I start doing now is I look at their websites and I look real quick for like, do you explain to me the problem that you solve in a way that's quick and compelling? Do I get it? And I'm always I try to be positive about people. I was confused.
I don't get it. They in the article doesn't articulate, hey, this is how we're going to leverage this acquisition to do like,
sense.
I don't get it. I didn't get it.
Interesting. All right, CashShield. This one came across. It was interesting. $5.5 million Series A. It's a big raise for an A. But here's what's really interesting to me, and there was some stuff on their website that I thought was actually kind of interesting as well. So they're cyber fraud prevention technology, and it's against card not present fraud losses. So if people don't follow this, and it's funny, if Jack Daniel were here, Jack and I go round and round on this. I have been, let me see if I can state this carefully. Economically, I think chip and pin was a big mistake. I get how the technology works, and I get that in the U.S. we're chip and sign. I don't think what people looked at was that the way that we do fraud in the U.S. is different than the way that fraud is handled in the European issuers. And that I always looked at it economically and said, I'm not sure where the problem here is. Pisses everybody off every time I say it. I just pissed off a bunch of you right now. Go ahead and send me the love letters, and we'll have that conversation. But what's interesting about this then is that they're looking at that card not present fraud. So when you got that chip and you go and you dip the chip, everything else, that's called card present. And so if you want to argue with me that you've reduced card present fraud, okay, cool. But what the prediction that I made years ago is that this would be what we call an efficient lever to card not present fraud. Guess what we see? Card not present fraud is taking off. So what's interesting is this is something that's working with the merchants. So the idea behind this, and I spent some time going over their website today, is basically they're using now. To be fair, they're using some buzzwords around, we're using machine learning and we're building real-time models, blah blah blah. But the idea is they're looking at the decisions as a retailer as to whether you should or shouldn't accept a transaction on the fly. And then what I thought was they offer 100% chargeback protection. That's kind of a big deal, because if you go look at the whole move to chip and pin, what got kind of, or the whole, technically more the EMV cards, what got kind of wrapped underneath it was you need to accept EMV cards or you'll accept total liability. By the way, when you accept EMV cards, you accept total liability. And so the merchants in a lot of these situations are the ones that get screwed. The card brands never pay. The banks always make their money. And I'm not trying to be hyper about any of this. It's just, I thought it was interesting that somebody has a model that works for the merchants, and it basically says, you're accepting credit cards online. You need it in order to do your business. You're worried about it. It's risky. You're not sure what you can send out. And you know what? We're going to help you make better decisions real time so you don't get screwed. And by the way, if we're wrong, we'll pay for it. I thought that was pretty ballsy. I don't know if this is an area you splashed in at all, but did you have any thoughts on this, Matt?
Well, so first of all, let's go to the chip and pin for a second. If we just deploy chip and pin, do we actually need these technologies, and do we need PCI? Oh, I just pissed off Jeff. Anyway, but I mean, look, come on.
Well, keep in mind though, chip and pin works for card present, and this is looking at the card not present.
Okay, so the card's not present. Do you still need the pin? I get it, but we can debate this one for a while. I think we should have gone full chip and pin personally and gotten rid of PCI and taken some headaches out of
right, like or at least like full tokenization, right? Something that just takes the decision away. I mean, gosh, right? We've been doing this long enough. Secure electronic transactions set like 20 years ago, figured it out, but. Anyway, I thought it was interesting for me because I find it's like fraud. Interesting.
But I love this press release because they have one great line in it, and I love this because look, they basically said 0% risk equals 0% reward. Back to the conversation we had earlier. All this is a risk reward game, right? If you're not willing to take risk, you're not willing to reap the rewards of going out and doing something in the business. And I just thought it was a great line in the article that I had to point out because this was something that we did when I was at Archer, which was, look, if you can harness risks, if you truly understand where your risks are, you are in a better position to what we said at the time was exploit opportunity, to take on more risk and be able to go reap the rewards of driving broad market opportunities, right? They're trying to do the same thing, so I think it's interesting. We'll see what it does, but I love the terminology in that press.
Well, and it's the first time. What I liked about it was it's the first time I've seen somebody say to the merchants who's not a payment processor, "Hey, we're going to help you make better decisions." Which, by the way, then means right. What's their exit? Their exit is one of the payment processors is going to snap them up. And
yep.
All right, Securonix.
Part of it. Yeah.
$29 million equity round. Thoughts?
Round. Ouch.
Yeah. Okay.
That's kind of the first one. Look, we saw Red Owl get snapped up by ForcePoint in an acquisition a couple weeks ago on the user behavior stuff. We've talked about, is this a feature and really should be tucked in somewhere else? You take a $29 million equity round. What's your exit now? I don't know. Look, the Red Owl acquisition was not announced on how much the value was. And I know there were some early investors in, so there had to be a pretty good valuation there. But holy cow, $29 million as an equity round is a lot of money to figure out what to do with. Forget about the valuation. It doesn't look pretty to me when I look at an equity round like this, because it means they were probably running short on cash or something that they needed to keep the lights on. I don't know.
No, I'll tell you what. I don't have a lot of background with them. When I was going through their website, the thing that stuck out to me really fast, they listed a lot of really cool clients, but then I went and I looked at where they were in the news, and I saw a lot of Fed heavy stuff, a lot of government heavy stuff. And then if you go and you look at the strategic advisory board, it's a lot of government, DoD, Fed heavy stuff. And a round like that, to me, that's where I kind of came up with it again today. I'm like, so this is basic, like they'll call it a platform, but this is a feature. And it almost feels like they're just trying to figure out where to shop themselves, right? Like I just got to stay afloat long enough, and they weren't going to get debt financing. Well, I don't know the numbers. That's a tougher sell. So this is a way that
it's a tough sell for me if I'm looking at it from the outside, because I'm just, that's a big equity round, and I don't think they've taken any financing before.
I couldn't find anything. You know, sometimes companies, like, it's weird because every now and then, like, you'll see it's a Series B, and you're like, well, where was their A or their seed, or like, wait, what? But then you meet some company, Matt. I don't know if you come across this. I've come across some companies that, like, they paper stuff funny. Like, you're like, did you take a seed round? No, we called it an A. But was it a seed round? Yeah.
Yeah,
okay.
I mean, some companies will go out to friends and family, pull a seed round to get them bootstrapped, get them going. Then you get on your first couple customers, you start to get your revenue up. Typically, you go out for an A. You know, I have lots of opinions on what realistic A's should look like. Not crazy multiples. Anyway, and then then you continue to grow, and then you go for a B, and off you go, right? If that's how you're going to do it. But an equity round after a seed round, that means they probably couldn't get an A. Or they couldn't get an A big enough. All red flags for me. And
to your point, 27 million. So it's not like it was a couple million to keep, like, I don't know. Yeah, there's a lot here. So I'll tell you, if you're watching and you're using them, or you've got insights, reach out to Matt or I. We're easy to find, and I'd love to hear more about it. Matt, it's always a pleasure chatting with you. It's been fun. I know we've even gone long. I hope people have enjoyed it. We get great messages when you join the program, and I always enjoy it. So, anything in your journey you want to update people on, or we just stay tuned and we'll talk soon?
Yeah, well, as most people know, I'm doing some advisory work for a couple companies and helping them along in certain areas. So, I think soon you'll start to see some of that come out, and we'll try to get them on the show. But I continue to track this market. Especially the container side. I just love the container space. So yeah, more to come soon, I'm sure. I'm
going to keep looking at it, I promise. And on my front, I talked to people last week about moving into some strategic coaching and really looking at isolating down where I fit in the marketplace. And I'll be fair, and you and I haven't really had a chance to talk about it, but our conversations have helped me a lot. So I know that you bring a lot of value to the program, but please also know, Matt, you brought a lot of value to me as I've looked at it. And I'm actually, like we've talked about the book Play Bigger, I'm actually now going back through the book Brain Audit, and I'm looking at where I've been focused enough. And it's neat because I feel like things are clicking and popping into place, frankly, finally. And so it's like, okay, we're getting caught up. So things here have been going well. That's episode 55. It's in the books September 15th. And we'll be back next week with more. Thanks for watching.